Yep.
Okay, it's
Then
good. It's good. I recall.
yeah. Then let's get started. So yeah, you know the basic smart money concepts, right? Like
Yes,
what
yes.
order blocks are, what
Y-
liquidity is, imbalances, and all that stuff. Yeah.
yes, man. I do.
Okay. Okay. So now let's get started with this. Now, do you know about the strong highs and the strong lows? Yeah, the strong highs and the strong lows. Okay. So
Yes, I heard
yeah,
about this. Yes.
yeah, so something like this, okay, because understanding that will be very important because that is what we will be using for entries and yeah, to get a directional bias and yeah, for confluence and everything. Okay, so let me show you. So
Okay,
a
okay.
strong high is something like this. Okay, a high that takes out liquidity and then breaks structure. That's it.
Yes,
Okay, this is all you want to see. Okay, it has to do a stop hunt, it has to
yes.
do a stop hunt, and then it has to give you a break of market structure. Okay, this
Reconstruction.
is it. This is all you want to see. Okay, so and also now when I say liquidity has to get taken out, it doesn't have to be equal highs all the time. Okay,
Yes,
or else it doesn't have to be a trend line all the time. No, just one single swing high or a low is still liquidity. Okay, like do you know the three candle formation for a swing high and a swing low? Yeah,
yes,
the
yes. I
three
do.
candle
Yes.
formation. Yeah. Okay, so if there is a swing high like this, okay, and if price runs above that high and gives you a break of structure, this
Yes.
will be considered as a strong high. Okay, that's it. And then yeah, same thing for a strong low. Okay, it has to run below a previous low and give you a break of market structure. This is it. Okay,
Okay.
so a stop hunt and a break of market structure. Okay, so yeah, remember this very well because this will be very important. Okay, this will be very important. And also, like we will not be focusing a lot into the lower time frame strong highs and strong lows. Okay, because yeah, on lower time frames you might have many and you will
Yes.
get confused. Okay, and you will get confused. So we will be looking at the high time frame ones. Okay, I'll show you examples. So we will mainly be focusing on the high time frame ones. Okay, now what happens in the market is something like this. Okay, so let's say we had a stop hunt. Okay, I'll just draw this out to you and let's get into charts. Okay, I'll show you
Yes.
some examples. I'll do yeah, let's do a top down analysis and everything. Okay, so let's say we had a stop hunt, a breakout structure, and then yeah, price might retrace and give you another break. Okay, so let's say this is simple. Yeah, this is simply market structure, right? Now we have this
Yes.
high. Yeah, we have this high. Then yeah, then we have this lower low, lower high,
Mm.
and a lower low, right? This is what we have. This is
Yes.
market structure. Now, if someone wants to re-enter, okay, if someone wants to enter the market, what will they expect? They would once again expect a lower high and a lower low, right? This is what anyone will expect because why the market is still bearish. Okay, the market is still bearish. So this is what the majority of the traders would expect. Okay, so first of all, what will the smart money traders do? Okay, what would the smart money traders do? Now they might look for maybe an order block or something in this area,
Yes.
right? They might look for an order block or something in this area, set their sell limits here, stop loss above that high, and they will target lower prices, right? So this is what the smart money traders would do. We know that.
Yes.
Now,
Yes. Yes.
not only the smart money traders, even the supply and demand traders would do the same thing, right? They'll tell you that this is the supply that broke the structure. Or they might tell you this is something like a rally, base, and a drop. Okay,
Yes.
they'll tell you
Yes.
that. Or else, yeah, now what we should understand is that not only smart money and supply demand traders wants to enter the market here. Okay, we have trend line traders. See that? Now we have the trend line traders. Now, what
Ah,
are they
yes. Yes.
expecting? Yeah, they are expecting a retracement back into the trend line and then a drop to the downside. So then what
Yeah.
they will do is, yeah, they will sell it once it gets here, stop loss above the previous touch to the
Uh,
trend line, and they will target lower prices. Right? This is what the trend line traders will
everyone
do. Yeah.
everyone put the stop loss at the same place.
Yeah, same place. Okay, like
Yeah.
we're calling us as smart money traders, and we're also placing the stop loss at the same place. Okay, so
Yes.
there's no difference at all. Now, not
Uh,
only trend line traders, we have break and retest. See that?
yes.
Break
Yes.
and retest. Now, what would they do? Like, you know what they use as a confirmation? Maybe something like a bearish engulfing candle. When price gets here and gives you that bearish engulfing candle, they'll sell it, stop loss above that candle, and they'll target lower prices. Okay,
Mm.
this is what they would do. And same thing with the support and resistance traders, because why? A broken support will turn into resistance. Okay, this is what we call a flip zone. Okay, this is what
Yes.
we call a flip zone. Okay, a
Yes.
broken support turning into resistance. We have that liquidity. And not only that, since this right here is a swing high, we have buy stops resting above that. Okay, because we know that above every single swing high in the market, there are buy stops resting. Okay,
Yes.
so now just think of it. In this little bit of price action, where is the most amount of liquidity? Above that high, right? Above that
Yes.
high. Okay, like the stop losses of 90% of the traders are above that high. Okay, so now as a smart money trader, if we do something like this, see, we're doing the same thing as a retail trader. They're entering from a trend line. we're entering from an order block, but with our stop loss at the same area. So there is no
Yes.
difference at all. Okay, so if you're a smart money trader, the main thing is to first think like the smart money. Okay, think like the smart money. Like, what are the intentions of the smart money? That is to take out the retail traders, right? Just to
Yes.
take out the retail traders. Now, in order to take out the retail traders, they have to obviously run above that high, right? They have to run above that high. So now, if you try to sell it here with your stop loss above this high, you're getting stopped out too. Okay, you are getting stopped out too with that retail crowd. So then what we will be doing is we will not be looking for anything around here. We will be looking for something above that. Okay, we will be looking
Okay.
for something above that. Okay, so yeah, I'll show you a lot of examples, then you will understand. But yeah, this is what we're going to do. We'll be looking for something above the liquidity. Okay, now this right here could be an order block. Okay, this could be a breaker block. You know what a breaker block is, right? Yeah.
A
This could
little bit just.
Okay, I'll tell you. Okay, this could be a breaker block. This could be a rejection block. Okay, yeah, don't worry. Everything's the same. Okay, an order block, a breaker block, a rejection block is the same
Yes.
thing, but in different forms. Okay, but
Okay.
I'll show you
Okay.
examples, then you will understand. Or else this could be an imbalance. Okay, this
Imbalance,
could
yes.
be an imbalance. Okay, this could be
Okay.
anything. But what makes it a high quality point of interest is the liquidity that is resting right below that. Okay, this
Okay.
liquidity is what's going to make this a high quality zone. Okay, so once again, yeah, now how are order blocks formed? Let's go through that. Then you will understand breakers and rejection blocks. Okay, so that then you will understand both of them, because
The
a higher time frame order block is a lower time frame breaker block. Okay, and a higher time frame rejection block is a lower time frame order block. Okay, something like that. So that's what I
okay.
told you. It's the
Okay.
same thing in different forms. Okay, it's the
Okay,
same thing in
d'accord.
different forms. So first of all, now how are order blocks formed? Okay, so let's first say maybe we had equal highs. Okay, let's say we had equal highs. Now, retail traders would think, okay, a double top is a sign of a reversal, right? They think this is the indication of a reversal. Then what they would do is, okay, once it gets into somewhere around here, they'll be expecting sell-offs like this.
Yes.
So they will try to sell it, stop loss somewhere around here, and they will target lower prices, right? This is
Yes.
what the double top traders would do. But the institutions, okay, or is whoever that runs these markets, they know that. Okay, they know that. So what they would do is they will place a huge buy order like this. They stop out everyone that wanted to sell from this double top, and after taking out their stop losses, they will place a huge sell order like
yes.
this.
Yeah.
Okay, so this is what happens. So an order block is the last push up before the push down, right? An order block is the last push up before the push down. We know that. Okay, then what we will be doing is, okay, now like we're not going to chase the move. Okay, we're not going to chase the move, because why? Now, what the institutions did was they placed a buy order from here, like multiple buy orders. Okay, not just one, maybe from here, maybe from here, maybe from here. They're placing buy orders to take out the stop losses of the double top traders, and then they do a huge sell off. Okay, so this right here is the formation of an order block, the last push up before the push down. Okay, this is the formation of an order block. Now, if you drop into a lower time frame, okay, if you drop into a lower time frame, you can refine it to one single candle that is down here. Okay, the last down move before the expansion to the upside. Okay, the last down move before the expansion to the upside is what we call the breaker block. Okay, this is what we call the breaker block, guys. This is the last injection of buys before the sells, right? This is the last injection of buys before the sells. So which means
but
this is where, this is where the sellers broke these buyers. Can you understand that? Okay.
I don't get why
down candle before the expansion. Okay, the last down candle before the expansion. Okay, so yeah, like honestly, that is something something from ICT, you know, that's something from ICT. Yeah. Okay, so if you just understand the logic behind it, that is like that is more than enough. Okay, that is more than enough, because just understand it like this: a higher time frame order block is a lower time frame breaker block. That's it.
Man.
Okay, that's because like if stuff is confusing you, don't overthink. Okay, just try to keep it simple. Okay, just try to keep it simple. As long as you know the logic behind it, that is the logic behind it, it's more than enough. Okay, that is more than enough. Okay, so yeah, something like that.
So
then,
most of excuse me, most of the time they only mitigate the breaker and not all the impulsive move.
Yeah, sometimes they just come back into the breaker and then they fall down. Okay, so I'll show you when to choose the breaker, maybe when to choose the order block, or I'll show you.
Okay.
So yeah, because everything depends on where the liquidity is. Okay, everything will depend on where the liquidity is. Okay, so yeah, this is what we call a breaker. And then Now let's talk about a rejection block. Okay, a rejection block is a candle. Okay, a wick. Okay, a rejection block is a wick. Okay, so
Yes.
something like this. Now let's talk about wicks. Okay, so now I'm gonna draw a bearish candle. Okay, I'm just gonna draw a bearish candle. Okay, yeah, that way you will understand it. Let's say we had this. Yeah, because it's the same thing, but yeah, in different forms. Okay, same thing in different forms. So let's see. Let me draw this out. Okay, so now let's say this right here is a bearish candle. Okay, this, let's say this right here is a bearish candle, and yeah, let's say the previous candle closed in here. Okay, let's say the previous bullish candle closed in here. Okay, so yeah, let me draw this out. Yeah, like this. So let's say the previous candle closed here. Yeah, so now where did the bearish candle open? Okay, where did the bearish candle open? From here, right? This is where the bearish candle opened. Okay, then as it opened, what happened now? Something like this. Okay, now I'm gonna draw the anatomy of this candle. Okay, so something like this. This opened.
Yeah.
Buyers started pushing it up. Can you see that?
Yes.
Buyers started pushing it up, and then sellers started pushing it down. Yeah, then they took over. That is why it closed as a bearish candle, right? That is why it closed as a bearish candle. Now what is an order block? An order block is the last push up before the push down, right?
Yes.
The last push up before the push down. So now in here, we're not going to look at the order block. We'll be looking at the rejection block. Can you see that?
Yeah.
The wick.
Yes.
See? So the base of the wick. Okay, if the base of the wick is untouched, we can use that as a point of interest. Okay,
yes. It's the highest
point of interest. Okay, can you understand that? Okay, simple.
Yes.
Simple, but it's very important. Okay, very, very important, because we will be using breaker blocks a lot. Okay, we'll be using, I'm sorry, not breaker blocks, rejection blocks a lot. Okay, the wicks, the unmitigated, the base of the wick, we will be using that a lot. Okay, so I'll show you. Okay, I'll show you a lot of examples. So can you understand this? Like, you understand the logic behind it, right?
Yes, I do.
Okay.
Yes.
Okay. So then, like, everything depends on where the liquidity is. Okay, so yeah, let's go to that. Then I'll tell you. Okay, now let's say right above this liquidity, we have a rejection block. Okay, then we're going to choose that. Let's say above that we have an order block. Then we're going to choose that. Let's say above that we have a breaker block. Same thing. Okay, we're going to use that, something like that. Okay, so everything depends on where the liquidity is. Okay, this is what's important. Okay, now what could happen is the market might retrace, and once it gets here, it might even give you a breakout structure on a lower time frame.
Yes.
Right? Now, after getting this breakout structure, inducements. Okay, now what happens? After getting this breakout structure, more and more sellers are getting in, right? Now, more and more sellers are getting in. Now, what they will do is, okay, they'll think this right here was their confirmation entry. Now, they will be expecting a retracement back into that lower time frame point of interest, and then expansion to the downside, right?
Yes.
This is what they would expect. This is what they would expect. So now they'll be looking for maybe lower time frame blocks like this. Okay, now they'll try to sell it here with their stop loss above this high now, because why? That way they can increase the risk to reward, right? And then they will have the same targets. Yeah, this is
they
what
sell more.
Yeah, they'll sell more. Okay, but now what happens is more and more sellers are getting in. Okay, and the best thing is the market might even respect these areas for a while. Why?
Yes.
More and more sellers, like, they're inducing. Okay, they're making more and more people get into this trade. Okay.
Yes.
And then what happens is, once enough liquidity is built up, they will do this. They will quickly start buying it up.
Yes, they take it.
They'll quickly, they'll take out everyone. They will take out everyone.
Yes.
And also, now what happened was, this right here was the lower high, right? If you're looking at market structure, the market was like this.
Yes.
This was the lower high. Now, if this happens, people will think this is a breakout structure.
Yes.
Right now, since price has gone above that high, now everyone will be confused. They will think, okay, now we have a bullish shift in market, right? They think we have a bullish breakout structure, but that is the inducement. Okay, that is the inducement. People are induced into believing that this right here was a breakout structure, but it's actually not. Okay, now you will understand this very clearly once we talk about trading ranges. Okay, because trading ranges will be very, very important. Okay. Trading ranges will be very, very important. So once we talk about trading ranges, you will see that this right here wasn't even a valid structural point. Okay, this is what we call internal range liquidity. Okay, this is what we call internal range liquidity. And then they buy it up, they take out everyone that wanted to sell here. Okay, and then remember, if they want to go lower, they will induce buyers into the market first. Okay, if they want to go lower, they're going to induce buyers into the market first. Because why
Yes.
would they do that? Because only if someone buys, they will have their stop loss below a low, right? Only if
Yes.
someone buys, they will have their stop loss below a low. So now what they're doing is they are inducing buyers into the market. So which means stop losses will get built up below these lows, and most importantly, below this low. Because
Mm.
why? Now people are expecting a retracement back into this area and an expansion to the upside,
Yes.
right? Now, smart money traders, once again, they'll start looking at odd blocks in here. Supply and demand traders will start looking at demand zones in here. Okay, some people, let's say maybe Fibonacci traders might draw their Fibonacci's like this, call this the golden ratio, sweet spot, and everything, and they will also
Yes.
buy it, stop loss below that. Okay, so now, yeah, like if you know ICT, he tells you liquidity is something like a magnet. Okay, liquidity is like a magnet, and price is like a paperclip. What happens? It draws towards the magnet, right? This
Mhm.
is what happens. This is what happens. So you will have to always know where this magnet is. Okay, where this magnet is, because that is where price is going towards. But remember, market structure is the most important thing. Okay, market structure will be the first one. Then comes liquidity. Okay, so structure combined with liquidity, because market structure is the one that's going to give you the direction. Okay, because
Yes.
if you understand the direction, the entries will be very, very easy. Okay, your entries will be very easy if you understand the direction, because that's the thing most of the people are struggling with. Okay, the direction. If you understand the direction, your entries will be very easy. Okay, so now what
Okay.
happens is, yeah, this moves up, will take out everyone that wanted to sell here, including the ones that got their confirmation entries, and then they induce buyers into the market. Now, see, buyers are induced into the market in the form of buy stops. Okay, buy stops are activated because
Yes.
since this was a swing high, breakout traders had their buy stops above that high,
Yes.
and then they will quickly push price back down like this. Okay, they'll quickly move down, and in these areas might give you reactions once again. Why? Because there are people who wanted to
To
buy it here,
induce.
right? They are
Yes.
induced. Now more and more buyers are getting in, and when enough when enough liquidity is built up, they will do this. Okay, then everyone gets
They
stopped
fuck
out. Okay, so
everyone.
yeah, exactly.
Uh.
Now then smart money traders will tell you, oh, order blocks does not work anymore. Order blocks aren't working
Yes.
anymore. We tried to sell it here, even the confirmation entry got stopped out. We tried to buy it here, even the confirmation entry got stopped
It
out.
doesn't work.
Yeah, it doesn't work that way. Okay, it doesn't work that way. Okay, so we will be focusing more on this. Okay, the entry above the retail pool of liquidity. Okay, the entry above the retail pool of liquidity. So the safe place for the stop loss is above the strong high, but yeah, I know the stop loss is too much. Okay, I know stop loss is too much. The risk to reward isn't that good.
21.
We can, yeah, we can have it above the point of interest. Okay, yeah,
Yes.
I don't use anything more than 5 pips or less than 2 pips. Okay, so the maximum would be 5 pips. Okay, so I'll show you. And then, yeah, and the other thing is like we don't even have to go into the lower time frames. Okay, like I'll show you. Okay, we can get the 3 to 5 pip stop losses from the 1 hour time frame itself, sometimes even from the 4 hour time frame. Okay, so I'll show you. Okay, yeah, you don't have to go into the lower times, because that's the misconception. People think if you are a smart money trader, you have to deal more with the lower time frames, the 1 minute time frame. No, that's bullshit. Okay, that's not it.
Yes.
Okay, you can just get tight stop losses like 3 to 5 pip stop losses from the 4 hour and the 1 hour itself. Okay, so I'll show you. And then, yeah, you sell it here. This will be your target. This right here will be your target. Okay, because why? The market was still bearish, and this right here was only an inducement. Okay, this was only an inducement. Okay, so something like that. So, yeah, can you understand this scenario? I hope.
Yes,
I
do.
Yeah.
I do.
Okay. And then, yeah, same thing in a bullish market. Let's go through that quickly. Okay, let's say we had something like this. Okay, so let's say we had something like this. So we had a stop hunt, a breakout structure.
This is a strong low.
Yeah, that's a strong low. Okay, and then yeah, another break in here. Let's say we had something like this. Now we have this low. Okay, higher high, higher low, and a higher high, right? This is what we have. This is just basic market structure. Now, if someone wants to enter the market, like I told you, what will they expect? They will expect a higher low and a higher high, right? This is what anyone will expect. Okay, this is what majority of the traders would expect. So even smart money traders, now what will they do? They will look for an odd block or something in here. Okay, they'll wait until price gets here with their stop loss below this. They'll try to buy it. Okay, and same thing with the supply and demand traders might tell you that there's the demand zone. Okay, or it's a drop base and a rally and everything, but they will also do the same thing. Okay, but not only smart money and supply and demand traders, we have trend line traders that are expecting the same thing. Okay, expecting a retracement back into the trend line and an expansion to the upside. Okay, so now they buy it here, stop loss here. Okay, this is what they would do. And not only them, like I told you, we have break and retest. Okay, support and resistance. Okay, we have break and retest, support and resistance, and who else? Since this low right here is a swing low, we have breakout traders. Okay, we have the breakout traders that are having their sell stops below that low. Okay, so now in this bit of price action, where is the most amount of liquidity? Right below that low,
Here.
right?
Yes.
Yeah, this right here is where the most amount of liquidity again could be an order block, a breaker block, a rejection block, or else an imbalance. Okay, this could be anything. Yeah, but what makes it a high quality zone is the liquidity that is resting above that.
Yeah. Okay.
Okay, this liquidity is what's going to make it a high quality zone. Okay, now what could happen is, yeah, in, and then once